Most people think markets react to bad news. They don't. Bad news is obvious. By the time it reaches your phone screen, millions of traders have already adjusted their positions. The reaction you see afterward isn't surprise, it's digestion. What markets actually struggle with is something else entirely. Information that hasn't been fully understood yet. That's where the real movement begins. Over the past few days, headlines have been loud. War, commodities moving, oil jumping, gold and silver swinging inside unusually wide trading ranges. On the surface, it looks chaotic. The kind of environment where investors feel they must react quickly or risk missing something important. But markets rarely reward quick reactions to headlines. They reward people who step back long enough to ask a different question. What is the market quietly adjusting to right now that most people haven't noticed yet? Because beneath the volatility, something more structural may be unfolding.
So before
Not a
jumping into
single
predictions
headline,
or price
not a
targets,
single
we need to
event.
slow down
A
and look
shift in how
carefully at what
capital is
actually happened in
positioning
the
itself
market over
around
the last
uncertainty.
several days.
And when that happens, prices don't simply move for a few days. Sometimes the entire cycle changes direction. So before jumping into predictions or price targets, we need to slow down and look carefully at what actually happened in the market over the last several days. Not the noise around it, but the measurable facts. Over the past several trading sessions, commodity markets experienced noticeable volatility, particularly in gold, silver, and oil. The movements began late in the week as geopolitical tensions escalated in the Middle East, coinciding with reports of military activity involving Iran. By the time markets opened the following week, investors had already begun adjusting positions across several major commodities. Gold prices moved sharply during early trading hours, briefly testing levels near the upper end of their recent trading range before pulling back. Throughout the session, prices fluctuated within a wide band, suggesting that buyers and sellers were both active but without a clear directional consensus. Despite the intraday volatility, gold prices remained close to where they had started at the end of the previous week. Silver followed a similar pattern. Prices moved quickly during the initial market reaction and then settled into a broad range of trading. Over the course of the session, silver remained within a band that has defined its recent consolidation period. While intraday moves appeared significant, the closing price relative to the prior week showed only limited net change. Oil markets, however, responded more strongly. Crude oil prices rose significantly compared to the previous Friday, reflecting immediate market sensitivity to geopolitical developments affecting potential supply routes in the region. The increase occurred rapidly, with a noticeable percentage move within a short period of time. At the same time, currency markets showed movement in the US dollar index. The dollar attempted to strengthen earlier in the week but faced resistance near previously observed levels. As trading progressed, the index moved back toward lower support areas. Overall, the defining feature of the week was not a single directional trend across all assets, but rather heightened volatility combined with relatively stable closing positions for precious metals. Oil was the primary exception, showing a more pronounced upward adjustment during the same period. These movements occurred within a broader market environment already characterized by elevated geopolitical attention and ongoing macroeconomic uncertainty. If you'd like, I can continue with Section 3. Short-term price movements often attract the most attention, but the more important question is what those movements signal beneath the surface. In this case, the immediate price reactions in gold, silver, and oil are less important than the broader chain of economic adjustments that could follow. The first layer is the direct market reaction. When geopolitical tension rises, commodities tied to physical supply risk, particularly oil, tend to respond first. Oil markets are highly sensitive to potential disruptions in transportation routes, production facilities, or regional stability. Even the possibility of disruption can lead to rapid repricing because global supply chains rely on relatively tight margins between supply and demand. Precious metals tend to respond differently. Gold and silver are less directly connected to physical supply risk and more closely linked to monetary conditions and investor positioning. During periods of geopolitical uncertainty, they often act as assets investors move toward when confidence in other financial instruments becomes less certain. The second layer involves fiscal and monetary dynamics. Large-scale geopolitical conflicts historically coincide with increases in government spending. Defense expenditures, logistical costs, and broader economic support programs can all place additional pressure on public finances. When fiscal spending expands faster than revenue, governments typically finance the gap through increased borrowing. Over time, rising government borrowing can influence currency stability and interest rate expectations. If debt levels expand significantly, central banks and financial markets must adjust to the growing supply of government securities and the broader implications for liquidity. The third layer involves investor behavior. When markets anticipate long-term fiscal expansion or currency pressure, capital often shifts toward assets perceived as stores of value. Gold has historically served this role because it is not tied to any single government's fiscal position. Silver, while partly industrial, often follows similar investor flows during monetary uncertainty. Another important factor is energy cost transmission. Oil prices influence transportation, manufacturing, and global logistics costs. If oil prices remain elevated for a prolonged period, those costs eventually work their way through the broader economy. Businesses may face higher input costs, which can affect pricing decisions and, in some cases, consumer inflation. This interaction between energy prices, fiscal policy, and monetary conditions creates a feedback loop. Energy markets respond first to geopolitical developments. Fiscal systems respond to the costs associated with those developments. Monetary conditions then adjust to the fiscal response. For investors observing commodity markets, the significance lies not only in the immediate price change, but in how these interconnected layers evolve over time. What begins as a geopolitical event can gradually influence currency stability, fiscal policy, and the allocation of global capital. Understanding those relationships helps place short-term volatility within a broader economic framework. If you'd like, I will continue with periods of geopolitical tension. Influencing commodity markets are not new. Similar dynamics have appeared multiple times over the past several decades, although the broader economic environment surrounding each event has always been different. One frequently referenced example occurred during the early 2000s. In the years surrounding the Iraq War in 2003, energy markets reacted quickly to rising geopolitical uncertainty in the Middle East. Oil prices moved upward as investors evaluated potential disruptions to supply and transportation routes in the region. At the same time, gold prices began a multi-year upward trend. Data from the early 2000s shows gold rising steadily from levels near $300 per ounce in 2002 to over $700 by 2006. This movement occurred during a period of expanding global liquidity and increased fiscal spending following the early 2000s recession. Another example appeared during the financial crisis of 2008 in the years that followed. While the initial shock in 2008 caused many assets to decline simultaneously, central banks around
Markets
the world
change
responded
gradually,
with
not
significant
daily.
monetary expansion.
This understanding
According
is
to
key.
historical Federal Reserve data, the U.S. Federal Reserve's balance sheet expanded substantially between 2008 and 2014 through several rounds of quantitative easing. During that same period, gold prices reached new highs, reflecting increased investor demand for assets perceived as stores of value during monetary uncertainty. However, it is important to recognize that the current environment is not identical to those previous periods. Global debt levels today are significantly higher than they were 2 decades ago. Data published by international financial institutions, such as the International Monetary Fund, indicates that global public and private debt has risen considerably over the past 20 years. Energy markets also look different today. The United States has become a major oil producer due to technological developments in shale extraction, which was not the case in earlier geopolitical cycles. This change has altered the global supply structure and the way energy shocks transmit through the economy. Another difference lies in the speed of information. Financial markets now react to news in real time through algorithmic trading and high-frequency systems. This can create faster price swings compared to earlier decades when information moved more slowly. Looking at history helps provide perspective. It reminds investors that geopolitical events often influence commodities and currencies, but the outcomes are shaped by the broader economic conditions surrounding them. Each period shares similarities, yet the underlying structure of the global economy continues to evolve. If you want, I can continue with the most important section. Professional investors rarely approach markets with a single prediction. Instead, they work through several possible paths and consider what conditions would need to develop for each one to occur. With commodities currently reacting to geopolitical developments and broader macroeconomic conditions, it is useful to think in terms of scenarios rather than certainty. QE, bull case, continued strength. For commodity prices, particularly gold and silver, To continue moving higher in a sustained way, several conditions would likely need to align. First, geopolitical uncertainty would need to remain elevated for an extended period. Prolonged instability often encourages investors to increase allocations to assets perceived as stores of value. While gold is traditionally the primary beneficiary of this behavior, silver often follows once broader momentum develops. Second, fiscal expansion could reinforce the trend. According to projections published by the U.S. Congressional Budget Office, CBO, U.S. federal deficits are expected to remain structurally large over the coming decade. If government spending rises further due to geopolitical commitments or economic support measures, borrowing requirements could increase accordingly. In that environment, concerns about long-term currency stability sometimes encourage diversification into commodities. Third, monetary conditions would need to remain relatively supportive. If inflation data remains persistent, or if central banks move cautiously in reducing liquidity, real interest rates could stay contained. Historically, lower real yields have tended to coincide with stronger demand for precious metals. Under these conditions, prolonged uncertainty, continued fiscal expansion, and supportive monetary policy, commodity markets could maintain upward pressure over a multi-year period. Base case stabilization. The base case scenario assumes that markets gradually adjust to the current geopolitical situation without a major expansion of the conflict. In this environment, energy markets may initially remain sensitive to supply risks, but eventually stabilize as global production adjusts. Oil producers often respond to sustained price increases by expanding output where economically feasible, which can moderate price movements over time. Precious metals could remain within broader trading ranges as well. Instead of accelerating sharply higher, gold and silver might consolidate while investors wait for clearer signals regarding inflation, central bank policy, and economic growth. Macroeconomic data would likely become the dominant driver again. Indicators such as inflation reports, employment data, and central bank policy statements would regain influence over asset pricing once the initial geopolitical shock fades. In this scenario, markets would transition from headline-driven volatility toward a more traditional macroeconomic environment. Price movements might become more gradual and tied to economic fundamentals rather than geopolitical developments alone. Countershort, bear case trend reversal. For commodity prices to reverse meaningfully, several factors would likely need to occur simultaneously. First, geopolitical tensions would need to ease more quickly than markets currently expect. A reduction in perceived supply risk could remove a key support factor for oil prices and reduce safe haven demand for precious metals. Second, global growth expectations would need to weaken significantly. Slower economic activity can reduce industrial demand for commodities, particularly those tied to manufacturing and construction. Third, monetary policy could become more restrictive than currently anticipated. If inflation declines faster than expected and central banks respond by maintaining tighter financial conditions, real interest rates could rise. Higher real yields have historically reduced the relative appeal of non-yielding assets such as gold. Under these conditions, easing geopolitical risk, slower global demand, and tighter financial conditions, commodity markets could experience downward pressure or extended consolidation. Thinking through scenarios like these does not guarantee outcomes. Instead, it provides a framework for understanding how different variables interact and how market conditions might evolve depending on which forces become dominant. If you'd like, I will continue with, when markets become volatile, headlines tend to dominate the conversation, but professional investors usually focus on a smaller set of indicators that provide clearer signals about underlying financial conditions. These indicators help separate temporary reactions from structural changes. One of the first indicators I watch is the US dollar index, DXY. The dollar plays a central role in global commodity pricing because most commodities are traded internationally in US dollars. When the dollar strengthens significantly, commodities often face downward pressure since they become more expensive for buyers using other currencies. Conversely, a weakening dollar can support commodity prices by making them relatively cheaper in global markets. Observing whether the dollar holds key support or resistance levels often provides early signals about capital flows across asset classes. Another indicator is U.S. Treasury yields, particularly real yields after adjusting for inflation. Treasury yields represent the return investors receive for holding government debt. When real yields rise, interest-bearing assets become more attractive relative to assets that do not generate income, such as gold. Historically, sustained increases in real yields have coincided with periods where precious metals struggled to maintain upward momentum. When real yields decline or remain stable, gold tends to perform more strongly. Inflation data also remains important. Investors pay close attention to Consumer Price Index, CPI, and Personal Consumption Expenditures, PCE, inflation data released by the U.S. government. These indicators influence expectations around central bank policy decisions. If inflation remains persistent, policymakers may face pressure to maintain tighter financial conditions. If inflation declines gradually, financial conditions may stabilize, which can influence asset allocation across markets. Beyond macroeconomic indicators, market positioning provides useful context. Trading volume, open interest, and liquidity conditions help reveal how investors are positioning themselves. Sharp price moves with limited participation may signal temporary reactions, while sustained moves accompanied by strong volume can suggest broader conviction. Monitoring these indicators does not eliminate uncertainty, but it provides a clearer framework for evaluating how markets respond as new information emerges. Periods of volatility often create the impression that markets are changing direction every day. In reality, many of the underlying forces influencing markets evolve gradually over time. Geopolitical developments, fiscal policy decisions, and monetary conditions all interact in ways that rarely produce immediate clarity. For investors, the challenge is not reacting to every headline, but understanding how those broader forces may influence markets over the long run. That requires patience, careful observation, and a willingness to adjust expectations as new information becomes available. The purpose of this analysis is not to predict a single outcome. Markets rarely move in straight lines, and uncertainty remains a constant part of the investment landscape. This isn't investment advice. It's simply how I'm reading the market right now. Risk management, patience, and disciplined thinking remain far more valuable than reacting quickly to short-term noise.